Our vibe on the street today, bulls versus bears. Wall Street strategist Ed Yardeni is pushing the narrative that the bull market is back, baby, telling investors that the Santa Claus rally may proceed through year end. Citi, however, is telling a different story, saying that U.S. equities are the exception and positioning in other markets such as Australia and Europe are still bearish. So let's break down some of the details on this for you as you're taking a look at the U.S. major averages. This is the year-to-date view here. Let's start with Yardeni because he sent this in a note to clients at the start of this week and talking about some of the concerns here that might be persisting, particularly around oil prices and higher bond yields. But he says that they've eased. So no moss there, and perhaps that's the reason why he's seeing more of this potential Santa Claus rally extending or spanning into the end of 2023.
Yeah, exactly. We were just talking to our guest in the previous block here, getting his sense of energy prices, where crude is right now, what that looked like here going forward. And he does expect to see some more pressure when it does come to crude pricing. So that obviously then points to what Yardeni is pretty much centering this thesis around, at least today, when we talk about the fact that we have seen a decline in energy prices. We have seen this pullback here in terms of bond yields. Obviously, that spike, that much of that easing here heading into the end of the year. So he clearly sees upside for equities. What that upside looks like for the S&P by the end of the year, 4,600. By the end of 2024, 5,400. In terms of what is going to lead the rally, I think is still the big question out there that's lingering right now. We have been getting some mixed commentary from our recent strategists, from some of the big business leaders that we talked to last week at our Invest conference. We did hear some bearish tone, especially from Jeffrey Gundlach. He, of course, though, is predicting a recession, and he thinks that we are going to see more pressure on some of these tech high flyers that had been leading the charge so far this year. On the flip side, though, we've been talking to some strategists this week who are a little bit more optimistic about how many of those big tech names are valued right now, and they do see some upside potential within that specific sector. We've also heard some bullish commentary on some of the banks, some of the financials here heading into the final weeks of the year. So Yardeni at least sees some upside, about 4% upside for the S&P between now and year end, and obviously even further upside, 5,400 by the end of 2024.
Yeah, and he put the odds of a recession, when you think about what this could look like by the end of 2024, 35% is what he's putting those odds at right now. And honestly, if you were to ask a sample of economists, analysts, and even consumers as well, and perhaps some investors out there, there's still going to be this lingering thought in the back of your head, just as there were among consumer fears that came through between some of the consumer confidence data points that had come out most recently, saying consumer fears of an impending recession remain elevated. That is consistent with the short and shallow economic contraction anticipated, in this case, though, for the first half of 2024. So you think about, on the other side of this, what could lead the rally? What could kind of continue to be one of those catalysts? Well, it's a good news, or it's a bad news is good news type of environment that we still find ourselves in, where if we do continue to see a slowdown in consumer spending at certain prices, then that could give the Fed more reason to believe, hey, we can continue to sit on our hands just for a little bit right now. If you continue to see as well a print that comes in below expectation on the jobs front, that could also lead the Fed to say, okay, now we're getting back towards some of the employment rate figures that we had earmarked, even if we were to get to that 2% inflationary target. And so all of those things the market will look at and say, well, now we've got a Fed that's going to be sidelined for a little bit and potentially issue some type of cut on the back half of next year is what economists are talking about. And then additionally, at that point, you might have us past the quiet cutting phase that a lot of companies are looking towards, and then the reinitiation perhaps of growth profiles, especially on a margin basis for many of the companies that have been able to benefit on the outset of the AI story and are now looking for another catalyst to point to.
Yeah, and it all comes down to the Fed, right? Exactly what the Fed is going to do. Essentially, when you take a look at the CPI print that we got this morning, it looks like market consensus is at least that a rate hike at the next meeting in December is essentially off the table at this point, looking ahead to the next meeting after that in January. Taking a look at the Fed fund futures here, 95% still see the Fed holding rates. And then, of course, it gets us to the question about whether or not we're going to see a cut next year and what the timing of that is going to look like.